The Chinese just did it again, vowing even more massive stimulus, this time from central authorities who are promising to stop declining home prices, to raise consumption, to save the entire private economy with more central government interference. Now, 10 years ago, something like this would have sent everything soaring in every direction. Now, stocks obviously love it. Bonds and energy markets, not so much. And that's odd because it isn't just China that's going broke for stimulus. The Fed just cut by 50, and there's a growing chance the next one from the Fed will also be a 50. Other central banks around the world, they're ramping up lower rates too, more so-called accommodation. The entire world is about to be awash in what everybody calls stimulus. So you'd think everything would be soaring. And a few places are seeing aggressive, irrational buying, Chinese stocks chief among them. But where do you expect to find support in the real economy? The reaction isn't just muted, it's non-existent at best. In some critical places like energy markets, oil and gasoline are down yet again today after failing to lift all that much off their multi-year lows set earlier this month. Neither rate cuts nor Beijing bazookas are convincing bonds and energy that anything has changed, or that nowhere near enough has changed. China did a huge pile of deficit finance spending last year, and all it got them was another year of needing to do even more deficit finance spending. The world's growing economic problems are far greater than rate cutting and deficits are going to fix. They impoverished everyone but a few big businesses the past 4 years, and now the downside to the supply shock has taken hold. It isn't going to be letting go. The only thing that's changed more recently is that now that the price illusion has faded, governments can now see it too. That's why the tidal wave panicky flood of stimulus from every direction. China, the Fed, the ECB, rate cuts, government spending, and everything else. There was already the frenzy from earlier this week when the PBOC announced a whole bunch of rate cuts and other measures aimed at supporting the economy, which produced an initial positive reaction that in some places didn't last all that long. Then yesterday or earlier this morning, China time, at its regular Politburo meeting, the Chinese central government authorities, and the Politburo is sort of like the cabinet over there, central government authorities ended up talking about economic matters, which is unusual for this time of year. The September Politburo meeting doesn't usually focus on economic matters. Instead, late in the afternoon, China time, they issued a statement which was all about reassuring everyone that this time the government means business, and what they mean is private business. And as usual in cases like this, when they want to reassure the world that they're on top of everything, they start out by saying how great everything is. The communication that was issued, the statement that was issued by the Politburo said, the overall economic operation has been stable and steady with progress, which, okay, why are we doing all this stimulus? The meeting pointed out that the fundamentals of my country's economy in favorable conditions such as a broad market, strong economic resilience, and great potential have not changed. And it was almost just like Jay Powell's press conference after he announced the 50 basis point rate cut. He started out by saying, the economy's doing so great, we felt the need to cut by double the usual amount. And here the Chinese are doing the same thing, reassuring the public that everything is just fine. Oh, by the way, we have to do this monstrous stimulus package because everything is strong and fundamentally sound. It's all a bunch of nonsense. It's all a bunch of smoke and mirror. It's all a bunch of psychology. Everything's fine, but we have to do all this other stuff that's because everything is not actually fine. And what all that other stuff entailed was, at least according to the statement, the meeting stressed that we should increase the intensity of counter-cyclical adjustment of fiscal and monetary policies, ensure necessary fiscal expenditures, and do a good job in the 3 guarantees at the grassroots level. The 3 guarantees are compulsory education, basic medical treatment, and housing security. This basic communist stuff over there. Continuing with the statement. We should issue and use long-term special treasury bonds and local government special bonds to better play the driving role of government investment. And so they're talking about issuing a bunch of debt to do a bunch of spending and redistribute where necessary, which they did this last year. They issued a ton of bonds last fall to the point that it disrupted the repo market because banks were buying so many of these bonds. And what did it lead them? As I said in the introduction, they did a whole bunch of deficit finance spending in 2023, only to have to do even more deficit finance spending in 2024. Back to the statement. We should lower the deposit reserve ratio, which the PBOC already did. And as I mentioned a couple days ago in a video, that doesn't do anything. It hasn't done anything in well over a decade that it's been tried. And implement a strong interest rate cut, which just like cutting the deposit ratio, the reserve requirement ratio, it just doesn't make any difference. We should promote the real estate market to stop falling and stabilize. We should strictly control the increase, optimize the stock, and improve the quality of commercial housing construction, which is odd because construction has pretty much stopped in the country anyway. And what they're basically saying is we don't want any more bubble type of behavior to erupt anywhere in the future, which only highlights the difficulties here, because it's that bubble building that a lot of China's economy depended upon. As you had external demand coming into China for China to become the factory to the world, that was one thing, but it also meant redistributing and reorienting society to more towards this industrial economy, which meant rebuilding houses all over the place, except it was building houses not for people to live in, but to build houses in many cases as investment properties for savings. And so what's the value of an enormous overhang of supply of investment properties when nobody will ever live in those domiciles? So it's a very critical problem that China has to deal with. And there really wasn't much as far as specifics in any of the statement. What was really communicated, which was intended to be communicated, was first of all the idea everything's just fine, don't panic. But secondly, because everything's just fine, we are reacting with urgency, and we're going to be strenuous and forceful in our response to everything being just fine. The contradictions do everything toward giving you a sense of how everything is really going there. Maybe the most important statement here was the fact that China's authorities realize they have a big economic problem. It's not just real estate, it's not just finance, it's real economy problems, employment. This part of the statement said, the meeting stressed the need to safeguard the bottom line of people's livelihood, focus on employment for key groups such as fresh college graduates, youth unemployment problem, migrant workers, people who have escaped poverty, and zero employment families. Zero employment families, there's a new euphemism. And strengthen support for groups with employment difficulties such as the elderly, disabled, and those who have been unemployed for a long time. We must strengthen assistance to low-income people, understanding that China's economy in its malfunctioning state is starting to build up these enormous bottom-up stresses. It's not just that retail sales aren't growing as robustly as they need to, it's that retail sales are failing to grow because the employment situation is undesirable, or whatever euphemism you want to use. What did they call it? Zero employment families. Well, zero employment families never used to be a problem in China because China was continuously growing. And now that it isn't, and now that it's stuck, suddenly they realize they have an employment problem on their hands. Welcome to the rest of the world, China. There were also a couple of other intriguing pieces of information that came out of the statement, including a potential bank recapitalization effort that we're not going to get to here on YouTube. And they raise a whole bunch of issues that I'll be covering at Eurodollar University's deep dive analysis. And right now at Eurodollar University, it's our fall sale. So if you're interested in the rest of the China story, along with a lot more, including why all of a sudden the Federal Reserve is likely to change how it calculates SOFR, well, to find out that, you've got to subscribe to our deep dive analysis, but you can do so at incredibly low sale prices. I've also got big savings on subscriptions for my daily briefing, as well as Eurodollar University's memberships. Information on what each of those offer and the details about the fall sale, that can all be found at our website, eurodollar.university. After the Politburo statement was released, Reuters reported some numbers that were they were whispered about, or probably some anonymous source that didn't want to be named because the matter was private. But whatever the case, Reuters reported that 2 trillion won, or about $284 billion in US dollar terms, in special central government bonds are planned to be issued. According to Bruce Pang, who's the chief economist for Greater China at Jones Lang LaSalle, 2 trillion won well beats expectations. This is a big bang fiscal stimulus that underpins both boosting consumption and diffusing risks. And I don't think that's actually the case. That's what economists are all going to say, because economists are trained as Keynesians to believe anything a government does anywhere is wonderful stimulus that will boost consumption and raise aggregate demand. Well, China's problem is they've been trying to raise aggregate demand without thinking about what the actual problems may actually be. So China's big government stimulus has been, reaction to it in certain places has been euphoria. Some of the most beaten down sectors related to China have rebounded sharply. Copper prices, for example. They were up big on Tuesday when the PBOC's stimulus fest, rate cutting fest, and they were up again another 3% today. At last check, copper was at $4.57, which is its highest price since the middle of July. And it had been down around $4 as recently as September 6th. So in this little bit of pause after the big flush in August into September, copper prices have rebounded sharply because copper is highly sensitive to Chinese macroeconomic conditions. The question remains about whether or not government spending will do anything more than what it normally does in copper markets and elsewhere, other than produce a short-run, temporary, all too brief and all too limited positive impact. So copper prices are up. Chinese stocks and Chinese-related stocks are up big. The Hang Seng Index in Hong Kong, that is up at a 14-month high near 20,000. It's up almost 20% from that August low, as investors have been betting. The worse it gets for China, the more stimulus will have to come out of the government. As more stimulus comes out of the government, some people realize that means the worse it is for China, but other markets don't care. Maybe this time it'll actually work. And so aggressive risk-taking on the idea that this time, unlike any of the other times, it will bear some kind of positive fruit here. The Shanghai SSE index in China, that's up 4% today, just reaching the 3,000 level. It's up about 10% in the last week. PBOC rate cutting and now the Politburo statement. Though we should note that it made a similar move in February after the last set of rescues were beginning to be announced earlier in the year that obviously didn't work and had failed. It's not just China or Hong Kong. The Nikkei stock index in Japan is up 4% today, nearly back to 40,000. Stock markets in general love governments, and anytime governments do anything, at least in the short run, until reality starts to set back in. And that reality is being priced into the bond market, including treasuries and bonds around the rest of the world. I talked about this in yesterday's video. The bull steepening uninversion trend is continuing to go global. Bonds in China, though. The 10-year treasury bond in China is yielding just 2.07%, and it's only a few basis points off of its record low, despite the idea that, okay, maybe this will be positive for China's economy. At least that's what authorities are saying. You would think this would be positive and therefore positive for China's economy, higher growth and inflation expectation, bad for the bond market. Not to mention the supply. Remember, the PBOC has been saying all along, this is a bond bubble. We don't want banks to buy bonds because when this sucker reverses, it's going to be big trouble. Well, you would think that rates would rise pretty substantially given the fact this is going to work. This is a big bazooka stimulus, if you believe that, as well as the huge issuance and supply. These should be bond negative. Yet, at least in the short run here, after the PBOC a couple days ago and now the Politburo statement, interest rates haven't moved all that much, if at all. One commodity that's also being bid, though, for the opposite reasons than, say, copper, that's gold. Gold hit a record high of $26.70. A lot of people say that's because of the inflationary risks due to all of this stimulus being issued by the government, and probably more that we don't even know yet. But gold rising not because of inflation fears, but because gold hedging recognizes the risk that we're really talking about here. The risk that things are really getting that bad that Chinese authorities feel they need to pull out the big guns, or what they're claiming are the big guns, and these markets really aren't buying it. Nor is gold. I mean, gold continuing to go higher, recognizing that Chinese authorities finally recognize what all the rest of authorities, central banks in particular, are starting to recognize around the rest of the world. But the big one, though, oil prices. You would think, given the fact that oil weakness has been concentrated, at least in mainstream commentary, on China, China coming out and promising to fix the Chinese problem would send oil prices soaring, absolutely shooting higher, especially with all the other supposedly oil positive factors, let alone dropping back below $70 per barrel. There was initial positive reaction on Tuesday with the PBOC, but then Wednesday, apparently traders in the oil market thought about what was being announced and what was being offered. These rate cuts from China, the rate cuts from the United States, the Fed, rate cuts all over the world. Maybe that's not such a good thing. Maybe that's reaction to weakness rather than a solution to it. So oil prices were down back below $70 per barrel, WTI in the US yesterday. And then they sank even lower today, despite the Politburo's promise to fix the China problem. So oil market, at least initially, isn't buying it. As of this morning, WTI was back under 70 against $68. It was down under $67 at one point. More than that, though, the WTI futures curve has narrowed. The level of backwardation has shrunk. I'm not talking about contango just yet, but that's starting to come within sight here. It's just over the horizon. The 1 month calendar spread is back to 52 cents. It's been under 50 cents at various points today. That's the narrowest the spread has been since early June. The 3 month calendar spread, the important benchmark there, is just over $1. Again, that one has narrowed substantially as well. Gasoline prices in the US. Gasoline, which never really rebounded too much off of their multi-year low set earlier this month, today back below $2 per gallon wholesale at the CME. And this despite the fact, as I just said, everything should be energy positive. Stimulus all over the world, big time in China. China's been such a thorn in the side of energy markets. The U.S. economy, rate cuts are coming more and more down the road. Rate cuts around the rest of the world. Not to mention, we've got a hurricane brewing in the Gulf, which is going to take some supply off. According to some sources, 511,000 barrels per day have already been shut as Hurricane Helene moves into the Gulf. That's according to the Bureau of Safety and Environmental Enforcement. So we've got restriction of supply there. We've got constant threats across the Middle East, escalating tensions and conflicts, as well as other sources of geopolitical tension. The Red Sea is still a big problem. And yet, with all of these supposedly energy price positive factors, oil prices continue to want to go lower in spite of them, which tells you that, first of all, this is about demand. And second of all, as it stands right now, energy markets like bond markets aren't buying that these are going to fix the problem. The more the Chinese do, the worse you know it must be. And this week, the Chinese have done an absolute ton, which says what about the potential for China and the global economy? So some markets are euphoric. Central banks around the world are cutting rates and aggressively cutting rates. The Chinese have finally awoken. They've pulled out the bazooka, the monetary stimulus, the fiscal stimulus, deficit spending, all of that. So for certain markets, this is a time to take a bunch of risk and bet on this time being different. While other markets realize that they've already done a bunch of these things. As I said, China borrowed a ton of money, ton of deficit finance fiscal spending last year, which only got them the need to do a bigger amount of deficit finance fiscal spending this year. Rate cuts. Chinese have been cutting rates for years. To what effect? The fact that the Federal Reserve is cutting rates. What does that mean? Is that actually stimulus? Or is that proof the Fed realizes the risks are maybe not risks? The problems of the supply shock era cannot be fixed by more central government spending and more interest rate cuts or any of the other things that are called stimulus. They're far deeper than that. And what these things really tell us is that the problems that we're confronting, the impoverishment over the last couple of years, the downside of the supply shock, even authorities can now see it too. In case you missed it from a couple days ago, what the PBOC announced, all these rate cuts acting like Oprah, rate cuts for everyone. That's the video linked below. As always, thank you very much for joining me. Check out Eurodollar University's fall sale. Thank you very much to Eurodollar University members and subscribers. And until next time, take care.